The US job market shows signs of resilience in the face of continuing trade uncertainty. Well, last week's non-farm payrolls data narrowly beat estimates with 139,000 jobs added in May. This week, the focus in the US will be on inflation when we get the latest CPI data. And next week, all eyes will be on the Fed and how they interpret all this data when policymakers make their interest rate decision. Well, James Smith is developed market economist at ING. James, let's start with the labour market. I said it's showing signs of resilience in my introduction, but do you believe it will continue to be resilient in light of some of the headwinds the US economy is facing?
I think resilient, yes, but nevertheless, this is a challenging environment. We know the uncertainty is still really high. I mean, I think the fact that we had that climb down in tariffs with China came just in time back in May to avoid a much larger fallout in the US jobs market. But nevertheless, if you listen to the anecdotes that the Fed collects in its beige book, hiring is softening. Firms are sort of not making these big decisions on expanding and so on. So I think for the rest of the year, the hope is, yes, the bottom's not going to fall out of the US jobs market, but nevertheless, this sort of hiring, this cool down in hiring that we're seeing at the moment should continue.
And this week we get the latest CPI data out of the US as well. What are you expecting there?
Well, it might be a bit softer, actually, than expected. It's kind of interesting. We've had a couple of months now where core inflation has been relatively benign, despite this sort of big rise in tariffs. You would have thought this might have triggered a more rapid increase in prices than we've seen so far. I think that will come. I think we will see more pressure on goods prices over the next few months. But it's worth remembering that services are actually a much bigger portion of the US core inflation basket. They're at 3/4 of the weight of that basket comes from services, and that side is looking much more benign. If you think of rental growth, that's been a key driver of US inflation. That's going to cool off over the next few months. And there's other things as well. Airfares have been consistently falling over the last few months as like tourism demand falls back. So that's a big counterweight to the tariffs. We expect to see that to continue this week, but also over the coming months as well.
So how does this all add up for the Fed next week? Markets aren't expecting a change. If they're right, when can we expect a cut?
Yeah, I think markets are sort of toying with the idea of the first rate cut to come in September. It could come later than that, to be honest. We know the Fed is very preoccupied with inflation right now. Some of the Fed speakers are saying if inflation goes to 3.5%, 4%, something changes in sort of inflation mindset among companies. And I think central bankers in general are very worried about going back to a period where we were 2 or 3 years ago, where inflation was much higher than expected. But I think as the year goes on, as we were just discussing, I think service sector inflation becomes more benign. Those concerns about inflation tail off a bit at the Fed. At the same time, I think concerns about the activity data will build. As I say, I think, all those calls for US recessions we saw a couple of months ago has faded back. But nevertheless, we're expecting a big slowdown. Those two things combined together means, September or perhaps more likely December for the first cut.
You said you're expecting a slowdown, but no recession. Why is that?
Well, I think the main word is uncertainty. That's going to hit investment. It is going to hit hiring. As I say, that jobs growth we've been used to be seeing is not going to be that high over the next few months. Consumer spending clearly is going to be squeezed by tariffs as well. I think it's just to say that over the last couple of years, where we've got used to that consistent 3% annual growth in the US, that's just not going to continue in the current environment.
Now, we know that Chinese and US trade representatives are meeting in London this week. Obviously, tariffs are having an impact already, and we saw today in China, exports slowed in May. Where do you see this going? Who needs a trade deal more, the US or China?
I think the answer is probably both. I mean, it was interesting, those Chinese export data that we saw. China's exports to the US slow a lot more than expected in May, despite that climb down in tariffs. And I think that is really just probably more reflective of the fact that front loading, we saw a lot of trade coming into the US ahead of the tariffs. That sort of effect has petered out a bit now. But I think the trade flows will continue. I think at the current rate of tariffs, 30%, most trade is still kind of viable, if more expensive. So we would expect those trade flows to resume or recover, that export growth to recover over the next few months. I suppose the question more broadly on tariffs is what happens next. Yes, we've got these talks. I think most people probably don't think that tariff level can come down much further. The real question now is, does it go back up again, particularly as we approach that August deadline?
That was James Smith from ING. And don't forget, you can watch more videos on Reuters.com.